Bubbles are great because if you get them early, you make a lot of money. But the trick is getting out. You don't make money in a casino until you've left the casino.
You're watching Silver News Daily. Subscribe for more.
War metal. The name alone carries weight. But did you know silver, long overshadowed by gold, could become the most valuable metal of this decade? As global tensions rise and economies brace for impact, the stars are aligning for silver to surge in ways we haven't seen in generations. What's driving this dramatic shift? And more importantly, how can you position yourself before the world wakes up to this opportunity? Stick around because what I'm about to reveal could change how you see silver forever.
And the overall flow of gold, depending on how you calculate the production of gold, it's 2 or 3% a year of all available gold is newly mined every year. So you could say there's 2 or 3% inflation in gold, i.e. they print more gold. And, a lot of gold people go, they don't print gold. They don't print gold. You can't print. They do. They dig it out with spades. That's printing of gold. There is more of it. But I'm very bullish on gold, and the Swiss keep a fairly large amount of it for me. But the interesting one is platinum because they make none 180 tons, and you could probably put that in the boot of your car. So, but it's not a lot a year. 180 tons of platinum. And the reason it's so suppressed at the moment is because everyone's thinking that cars are going to go to be totally electrified. And all those cat converters, 30, 40 years of cat converters, well, won't be that much out there, but, a number of years with the cat converters with platinum and palladium in them, that's all going to become platinum. And therefore, it doesn't matter they're only digging 180 tons out of the ground because there's all these cat converters that can be melted down, or rather, cut off your car while you're not looking, ground into powder and shipped to China for reprocessing. Yeah? But that's going to end. And sometime in the next not many years, that's all going to end because it's all going to be electric cars, maybe. But, the cat converters to platinum is either going to go back the other way or stop. And then there'll still only be 180 tons coming out of the ground. So that is a very interesting long-term stack. And I know your viewers are often stackers. I'm stacking platinum. I can't, as long as I live long enough, I can't see that that's anything but a one-way bet because they just don't make it platinum. It's just like, how many tons a year? You're kidding me. That's like none. So, gold, silver, platinum, palladium, why wouldn't you stack that?
Throughout history, silver has been more than just a shiny commodity. It's been a lifeline during times of upheaval. From ancient empires stockpiling it during wars to its role as the backbone of coinage in global economies, silver has stood the test of time. Take the 1970s, for instance. Soaring inflation, geopolitical conflicts, and an oil crisis sent silver prices skyrocketing by over 700%. And here's the kicker. The current global climate mirrors many of those conditions. Could silver be about to repeat history and become the ultimate safe haven again? Stick with me, because what we're seeing now might just be the beginning of something historic.
If you dig a hole and you start, doing some chemistry with it, out pops silver. Silver's in it. Pretty much every metal that you mine, lead, copper. Although gold comes out of copper quite a lot, but silver basically comes out of all anything you do in minerals, you're going to get some silver there. So the amount of output of silver is really what causes its price differentiation with gold. And if you're interested in that sort of thing, the one that boggles my mind is platinum. It's 180 tons a year of platinum being made. 3,200 tons of gold. Platinum's $1,000 an ounce. Gold is, wherever it is today, 2,800 or whatever. So there's basically no platinum getting made. Yeah, and it's a very, very important metal going forward for things like all the green environment, because it's a catalyst for lots of chemical processes that are key to decarbonisation, whether you believe that's a thing or not. It was definitely a thing, but it's whether you believe it should be or not. But platinum is massively, and palladium is massively important in chemistry. And chemistry is going to be very, very important for the future with all the strategic minerals and all the new technology and the hydrogen economy that may be coming along. And all that, and I believe it's going to be a big thing, hydrogen economy. And platinum's a big, hairy deal, batteries, etc., etc. And there you are, 180 tons a year coming out of the ground. And gold, 3,200 tons. See, if you look at gold, and people say, oh, well, it's hard money and it's real money and there's no inflation with gold. Gold's inflating. Every year they're doing another 3,000 tons with it. It's about, depending on how much gold you think there is, because remember, gold gets lost. And gold isn't very liquid in as much as all the gold the governments hold, that's not going anywhere. Yeah. So the free flow of gold is a lot less.
Let's take a hard look at the world today. Rising tensions between global superpowers, the escalating conflict in the Middle East, and the looming shadow of a new Cold War. Each of these factors sends ripples through the global economy. Historically, periods like this push nations and investors to seek safety in tangible assets like silver and gold. Just think about the recent surge in central bank purchases of precious metals. China, Russia, and even smaller nations are quietly stockpiling reserves. Why? Because when trust in paper currencies erodes, the value of metals like silver often skyrockets. The question is, how long will it take for the wider market to catch on? And when it does, will you be ready?
The king by giving them a big cask of gold. It will be credit. It's always been credit. There's always been credit. From the beginning of time, there's been credit. Gold was just a currency so that people could have it in their pocket. But, there was still plenty of paper money out there, plenty of bonds and plenty of IOUs. The whole point, the whole first banks, the whole point is I'm a guy, I got a bit of money and I've got it under my bed because it's the 15th century. So what am I going to do? Someone's going to rob me. So I go down to the goldsmith and say, could you take this gold, put it in your safe and give me an IOU, please? That's the beginning of paper money. And that's what the other goldsmiths became the banks. That's why banks exist, because you don't want a big chunk of money in your house because they want to steal it. So you take it to the guy that is good at securing money, you give it to him, he might even charge you to keep it. Or maybe he'll pay you to keep it. He gives you an IOU. That's money. So, the idea that gold and silver are somehow, has to be currency, it's the only currency that possible is actually not a thing. But they have use cases. Gold is for war. And the tension is not going to stop going up for years. I mean, when's it going to stop? When is it going to stop? It's going to go on and on and on and on. So gold is going to go up and up and up and up. Now, silver, that's poor man's gold. It has a use case. But, it's a B2C material. It's not a B2G, business to government or government to government. So gold is the one for increasing global tension. Silver will follow on, obviously. But, gold is the one that is going to be driving it all, because the world is, until they work out how to stop social media driving everybody mad. And, it's not just me and you who get driven mad and irritable and anxious by global media. It's all of them. Nobody more so than the politicians of this world. They're absolutely compelled by media, always have been. And social media's driving them all mad. You can see them go mad on X in real time. Yeah. So that driving of everybody getting more and more stressed out, more and more anxious, and more mentally unstable, that's going to go on for years, and that's going to be in governments and geopolitics, and it's going to drive the price of gold. And it's a one-way bet, gold, for the next 4 or 5 years, in my opinion.
The balance of power in the global precious metals market is shifting, and it's happening faster than most people realize. For decades, Western exchanges like COMEX in the U.S. dominated the pricing and trading of metals like silver and gold. But today, the East, led by nations like China and India, is challenging that dominance, and they're doing it with a radically different approach. Take China's Shanghai Metals Exchange as an example. Unlike the heavily rehypothecated Western markets, where the same ounce of silver might be traded dozens of times without ever physically existing, the Shanghai Exchange operates on a 1:1 ownership model. That means every contract is backed by actual physical metal. This transparency builds trust and credibility, making it a magnet for investors looking for security in an increasingly volatile world. And it's not just about transparency, it's about strategy. Countries like China, India, and Russia are buying precious metals at an unprecedented rate, and are doing so for two key reasons. First, to protect themselves against the weakening U.S. dollar, and second, to position themselves as leaders in the coming green energy revolution, where metals like silver and platinum will play a pivotal role. But here's where it gets even more interesting. These nations aren't just stockpiling. They're systematically undermining the Western system. By accumulating physical metals and leveraging Western economic vulnerabilities, they're gradually wresting pricing power away from traditional Western institutions like COMEX. Experts like Craig Hemp predict that this shift could lead to a complete revaluation of silver prices, especially if the West is forced to abandon its heavily leveraged, paper-based system. The implications of this are enormous. Imagine a world where the East controls not just the supply, but also the price of silver. That's the direction we're heading, and the average investor hasn't even begun to notice. The window to secure silver at its current prices is closing fast, and when the tipping point comes, it's the nations and individuals holding physical metals that will hold the power. So the question is, are you prepared to adapt to this seismic shift in the financial landscape? Or will you be caught off guard as the rules of the game are rewritten?
First of all, what's the use case for gold and silver? The use case for gold, why do governments keep, warehouses full of gold? Do they like jewelry? Have they got dentists that they're going to need it? No. Are they going to sell it to the electronic industry? No. Why do governments need gold? They need gold for what? Gold is for war. That's why they keep it. And if you're a politician that believes that there shouldn't be wars, you sell your gold. And you're likely to be a socialist, and you might even be English. Because you can't fight a war if you haven't got gold. How are you going to fight a war without any gold? When they say, yeah, you want the oil? Yeah, you're fighting a war. You might lose. Give us gold, please. Send us the gold. Oh, no, can I send you a bond? No, we don't want that. Send us the gold. Gold is for what? All right, that's the use case. And guess what? We're not going to, please, let's not have one. But global tension is increasing. And as global tension increases, if you're a government, you've got to buy gold. That's why the Chinese are buying gold. It's the Chinese government. Why are they buying gold? Do they want to give it down to people who want to build Rolexes? I don't think so. Do you think they want to, boost the dentistry industry? I don't think so. Yeah, gold is for war. And as global tension increases, the price of gold will go up in real terms. Now, if everybody decides to go to the UN and sing Kumbaya and all be friends, we're going to be friends now. Why don't we just cooperate? Why don't we be sensible? Well, gold will come down if that happens, but it's not going to happen, is it? I mean, everywhere you look, tension is increasing. So gold is going to go up. So you don't have to remonetize gold. I mean, people think, oh, in the old days, people had gold in their pockets and silver in their pockets, and it was real money. It was way more paper money. There's always been paper money. There was paper money in Britain in the Middle Ages. They were wooden sticks, and they would carve IOU into the wooden sticks and split them down the middle. Now it's called a tally stick. So it wasn't quite paper. It was actually a wooden stick. And they put them in the basement of the Houses of Parliament to keep track of it. So you could go back, I got my half stick. I want my money now. Right? And the sticks caught fire and burned the House of Parliament down. So there's always been paper money. I mean, if you were a duke in the 14th century and you're going to ride to Paris or something, you'd ride to Paris with a piece of paper. You go into a bank and say, this is my IOU from the bank in Milan, and they give you some money. It'd still be paper. There's always been paper. There's always been credit. The people didn't lend money to...
Have you noticed how central banks are quietly changing the game? Under Basel III regulations, precious metals, especially gold and silver, are being reclassified as high-quality liquid assets, meaning they're now considered some of the safest assets a bank can hold. But why does this matter? Because this is sparking a global movement among central banks to accumulate these metals in record amounts, and silver is playing an essential, albeit quieter, role in this strategy. Let's dig into the numbers. In 2023 alone, central banks purchased over 1,100 metric tons of gold, the highest annual total on record. But here's the twist. As gold becomes harder to acquire, silver is emerging as the more accessible alternative. Nations like China, India, and even Saudi Arabia are leading this accumulation wave, quietly diversifying their reserves away from the US dollar. This isn't just about hedging against inflation. It's about a deliberate strategy to reduce reliance on the Western financial system. And silver is a critical part of that playbook. But what's really driving this accumulation? Two factors: trust and survival. Central banks understand that fiat currencies, especially the US dollar, are losing their credibility on the global stage. Decades of money printing and rising debt levels have eroded the dollar's purchasing power, and countries are looking for a safety net. By stockpiling tangible, universally valued assets like silver and gold, they're building a firewall against potential economic shocks. And let's not forget the geopolitical angle. Nations like China are preparing for potential conflicts, both economic and military. Silver, often referred to as the war metal, plays a dual role. It's essential for industrial use in technologies like solar panels and electronics, but it's also a time-tested store of value. Central banks know this and they're taking action. Now here's where it gets even more critical for individual investors like you. As central banks continue to drain the supply of physical silver, they're tightening the market in a way that could trigger explosive price movements. The disparity between institutional accumulation and retail demand is already widening. While retail investors focus on speculative assets like cryptocurrencies, central banks are laying the groundwork for the next financial paradigm, one where precious metals like silver dominate. So, what does this mean for you? The clock is ticking. As central banks and institutional players quietly corner the silver market, the opportunity for everyday investors to secure affordable silver is shrinking. The question is, will you act before it's too late?
6 years ago, and gone on a cruise for the last 6 years, rather than go around trying to, pick other stocks. But nonetheless, when I look at the market and I get a nosebleed at the valuations, what I see, what I feel, what I think is we haven't had a bubble yet. We've had a boom, but not a bubble. And these things don't come to an end with a whimper. They always come to an end with a bang. And they always come to an end when there's a bubble and everybody's singing Hosanna. And it's going to go to the moon. It's going to be NASDAQ 10,000 million billion. And then they never do it when it's just really good. It's only after it's gone mental that these things come crashing down. And we haven't had that crazy bubble yet in the NASDAQ, which is, really where all the stuff lives. So I think soon, maybe not weeks, maybe not months, but probably not many years, we will get that bubble in the NASDAQ. And it will be just like, 2000 all over again. And there'll just be mad companies. It won't just be half a dozen ridiculously overvalued companies. They'll be popping up all over the place, and there'll be, IPOs at 200 billion, 300 billion, 500 billion, a trillion. And everyone will be going, oh, everything's marvelous. We're going to Mars with Elon. And that will be a bust, will then follow. So the thing to watch out for is that a crazy bubble begins, and anybody that likes to trade or, wants to, do that, run up that bubble and make a lot of money at that point, will be able to see it early. The other thing is, people will be able to see when that's happening that the end is near. And, bubbles are great because if you get them early, you make a lot of money. But the trick is getting out. You don't make money in a casino until you've left the casino. It's not a profit until you take it. And, it's no good having some, chip company that went from 1 to 50 if you ride it all the way back down to 2 again. So when that bubble begins, you'll be able to say, oh, here's that bubble that crazy English bloke said was going to come. And you can take advantage of it. And there'll be wonderful IPOs. And if you're in a position to pick them up, you'll be able to pick them up. And if you're in a good company that's ridiculously expensive, it'll get doubly ridiculously expensive. It'll be a good time to, reap that harvest. But don't believe it's going to stay there and that bubble isn't going to burst. So what I'm saying is there will be a bubble. We haven't had a bubble. We've had a great boom. Haven't had a bubble. There will be a bubble. When it starts, you'll be able to take advantage of, oh, here's that bubble. But when it gets to a certain stage...
Silver isn't just a precious metal. It's an industrial powerhouse, and it's becoming indispensable in the race toward a greener future. As the world pivots to renewable energy and carbon neutrality, silver is emerging as a critical component in technologies that will shape the 21st century. Let me break it down. First, let's talk about solar energy. Did you know that silver is a key ingredient in solar panels? It's used in the photovoltaic cells that capture sunlight and convert it into electricity. In fact, nearly 10% of global silver demand already comes from the solar industry. And with the International Energy Agency forecasting that global solar capacity will triple by 2030, the demand for silver is set to explode. Some experts even warn of a supply crunch as silver reserves struggle to keep pace with this surging demand. Then there's electric vehicles, EVs. Silver plays a vital role in EV, from the batteries to the intricate wiring that powers these vehicles. As governments worldwide push for bans on internal combustion engines, EV production is expected to soar, another major tailwind for silver demand. Just think about the Biden administration's aggressive EV targets, or the European Union's commitment to phasing out petrol cars by 2035. All these initiatives point to one thing: skyrocketing industrial demand for silver. But here's the kicker: silver isn't just a green energy enabler. It's also critical to the future of the hydrogen economy. Silver's unparalleled conductivity makes it essential for the electrolysis process that generates green hydrogen. And as nations invest billions into hydrogen infrastructure, silver's role in this transformation cannot be overstated. The problem: silver isn't an infinite resource. Unlike base metals like copper or aluminum, silver reserves are limited, and mining is becoming increasingly costly. Combine this with its dual role as both an industrial and precious metal, and you have a perfect storm brewing, a scenario where rising demand clashes with constrained supply. So here's the big question: are you ready to capitalize on silver's industrial renaissance? Or will you wait until the market fully wakes up to its role in the green energy revolution? History has shown that those who recognize these trends early often reap the biggest rewards. And trust me, silver's story in this energy transition is just beginning.
It'll be time to leave. And, don't miss out on that. So even if you've got holdings and you see this bubble and it goes bubble, bubble, and everybody's singing Hosanna and there's all these crazy things happening and it's all marvelous, that would be the time to consider de-risking what you've got. So like now in crypto, the Trump coin, now that is a klaxon signal that this is the top of this run. That is, a few people who've done very well in crypto over the last couple of cycles are exiting right now going, oh, here he is. If the Trump coin 200 multiplication that we saw in the last few days isn't the bit that's going to be the last chapter of the crypto bubble of 2025, I don't know what it's going to be. And it is a strong signal that the run that we all enjoyed in crypto has come to an end. And I've been saying it for a few weeks now that this is probably pretty near the top in crypto and that we might see 120, but it's going to be very, very unlikely it's going to go much further. And if you got in at 20,000 and you're sitting on a 5x, what are you hanging on in there for? And I took my 5x and I'm now sat there prepared to cry as it doubles and triples and quadruples. But you have to, in all these situations on these crazy verticals, whether it's coffee, whether it's a stock, whether it's a crypto, you haven't made a profit until you've left the casino. And I think it's not a bad time to certainly find out where the exit is. So when you decide to head for the exit, you know where it is. because it's, it is pretty toppy out there, and it's behaving in exactly the way that the end of these runs happen. So back in the crypto previous run, it was the altcoins, so-called, the polygons, the matics, that went, I bought it at 3, bailed at 32, and it went to 400. I missed that yacht. I didn't get that yacht, but I did all right. I got some nice houses out of it. But that was the signal that the end of that run was arriving. Okay, and this time round, it was the AI meme coins that were doing that, 10x's and 20x's out of nowhere, and that seems to be all over that. And now we've got this clarion call from the Trump meme coin, and I would be very surprised if we are not in crash territory within 3-4 months.
While silver grabs the headlines as a key player in the green energy revolution, there's another metal quietly poised for an equally dramatic breakout: platinum. Often overshadowed by its shinier cousins, platinum's unique properties make it indispensable in the technologies driving a greener, cleaner future. Let's start with hydrogen. Platinum is essential for the hydrogen economy, particularly in fuel cell technology. These fuel cells use platinum as a catalyst to convert hydrogen into electricity, emitting only water vapor as a byproduct. With global investments in hydrogen infrastructure projected to reach $300 billion by 2030, platinum demand is set to surge. Countries like Germany, Japan, and South Korea are leading the charge, betting big on hydrogen as a cornerstone of their energy strategies. But platinum's story doesn't end there. Its role in catalytic converters, a component that reduces harmful emissions in vehicles, remains critical, even as the automotive industry transitions to electric and hydrogen-powered vehicles. And here's a fascinating twist. The push for decarbonization is expected to drive innovations in hybrid technologies that still rely heavily on platinum. What makes platinum's case even stronger is its extreme scarcity. Only about 180 metric tons of platinum are mined each year. Compare that to the nearly 3,000 tons of gold produced annually. This limited supply, coupled with growing industrial demand, creates a perfect setup for a supply squeeze that could send prices soaring. Here's another factor to consider: recycling. Unlike gold and silver, platinum recycling is far more complex and expensive, which means that once it's used in industrial processes, much of it is effectively lost to the supply chain. This adds even more pressure on primary production to meet rising demand. Now, why does this matter to silver investors? Because platinum and silver often move together as part of the precious metals family. When silver prices rise, platinum usually follows suit, driven by similar dynamics of industrial demand and safe haven status. Together, they create a powerful duo for those looking to hedge against economic uncertainty, while also tapping into the green energy boom. So here's the takeaway. While the spotlight might be on silver, platinum is the silent ally that deserves your attention. By understanding how these two metals complement each other, you can build a diversified strategy that positions you ahead of the curve. Are you ready to add platinum to your playbook?
Well, yeah, I mean, insider selling is always a good signal that you're near the top of the market. And no one can say the American market is cheap in various areas, but there's still quite a lot of value, because what seems to be going on is a permutation of what you do if you're a hedge fund. Is you pick the darlings and you go long, and you pick the dogs and you go short. Okay, now if you take that, now you're market neutral, and it doesn't matter whether the market goes up or down, you're going to make money. That's the theory, and that's worked very, very well. But at a certain stage, you run out of shorts. So now you've got to spread your shorts amongst things that aren't so well correlated. And I think in the end, the logical conclusion is you get the Magnificent Seven and a lot of short positions all over the place in all sorts of areas to try to capture the short position. So the incredibly high valuations of the stars doesn't necessarily turn into incredibly high valuations of the second tier or the third tier. So if you look at someone like Intel, who are absolutely flat on their back. And I'm quite long Intel because, if you're going to have a trade war with China, when all your chips are coming out of Taiwan, you need to have fabricators, chip fabs, not in Taiwan, somewhere else. You've got to have them in America. You've got to have them in Europe. And you can't build them like that. It's not like a Elon Musk rocket being knocked out every 10 minutes. These things take years and billions to build. And the king of the fabs is Intel. These guys have got, they are the fab guys, effectively. And so you look at their stock and you go, wow, they're in comparison with the other guys, and NVIDIA, they might as well be free. It's pocket change for a lot of people in the top end of the market. So there is value out there. There is absolutely, without doubt, value in the American market. When you look at the nosebleed valuations of the NVIDIAs of this world, maybe what you're looking at is the sort of turbocharged hedge fund idea of backing the stars and shorting the dogs. And that has a systemic effect that is what would turn into the bubble. The other thing you've got to really grasp
There's a fascinating divide unfolding in the precious metals market, a tale of two types of investors. On one side, we have wholesale buyers like central banks, governments, and institutional investors, quietly stacking gold and silver at record levels. On the other side, retail investors, distracted by speculative plays like cryptocurrencies and tech stocks, are largely missing the boat. This growing gap between wholesale and retail behavior is creating a massive opportunity, but only for those who can see what's happening behind the scenes. Let's break this down. Central banks worldwide are hoarding precious metals at unprecedented rates. In 2023, central banks purchased more gold than at any time in the last 55 years, and their appetite for silver is quietly growing too. Why? Because these institutions understand the fragility of fiat currencies and are preparing for a potential reset of the financial system. While most people are focused on headlines about stock market gains, these insiders are fortifying their reserves with tangible assets. Now contrast this with retail investors. Many individuals are chasing speculative bubbles, pouring money into high-risk assets like meme stocks and trendy cryptocurrencies. Others are being forced to sell off small amounts of silver and gold just to meet everyday financial obligations. According to industry experts like Andy Schechtman, this creates a stark disparity. Wholesale buyers are playing the long game, while retail investors are stuck focusing on short-term trends. But here's where it gets interesting. This disconnect is not just about who's buying, it's about how. Institutional buyers are snapping up physical metals, while retail investors often settle for paper assets like ETF, which don't offer the same level of security or value. The result? A tighter supply of physical silver, which could lead to a significant price breakout when demand outstrips availability. And let's not forget the looming industrial demand for silver we discussed earlier. When you combine the green energy revolution with the quiet accumulation by wholesale buyers, the pressure on silver's supply becomes almost inevitable. For retail investors, the window to acquire physical silver at reasonable prices is rapidly closing. So, what's the big takeaway? The current disconnect between wholesale and retail trends is a gift for those paying attention. By understanding where the smart money is moving, you can align your strategy with the forces driving the market, not against them. The question is, will you seize this opportunity, or let it slip through your fingers while others quietly stack their wealth?
these days is these aren't efficient markets. These aren't free markets. These are highly curated markets. And the curation is coming out of government, central bankers, because their monetary policy is to print money to keep the money flowing, but to get people to stack it into illiquid assets. Because if you give poor people money, not only do they need to spend it, they want to spend it. They go down the supermarket and buy tomatoes and the price of tomato goes to the roof. If you give money to rich people, they go, what am I going to do with this? I've got more money than I need. I'll give it to the bank. I'll buy real estate. I'll put it in stocks. So the real estate goes to the roof. Everybody likes that. It trickles down. People sell their house, whatever, feel rich. It's a trickle-down effect. Way uninflationary. That's why QE first time around didn't create inflation, because it went straight into illiquid assets or less liquid assets than cash. And equities is, buy and hold. Well, what happens to the money when you print it, give it to rich people, and they put it into Intel, or not into Intel, into NVIDIA? It doesn't go anywhere, does it? It gets stuck there. And it stays there, and then nobody's running down the supermarket to buy lettuce. It's got into a stock. It's in the financial system. It's into less liquidity instruments, which is how the central banks manipulate money supply. They push it up and down the liquidity curve. When they need liquidity, they pull it out of illiquid into liquid, and they can push it backwards and forwards using interest rates and QE and QT. And so what you are seeing in the markets is this liquidity made by the central bankers to keep the wheels on after COVID, and to fund the American government spending more money than it can borrow properly. You can't borrow it off the Chinese; they don't want it anymore. So the Fed uses its clever tricks, a way of recycling cash and printing cash and buying treasuries off the government. So there's all that going on, but it's going into illiquid or less liquid assets than cash, like equity, like real estate. And so you've got this relative increase in value, of real value in these assets, because that's a mechanism whereby liquidity is driven through the system these days. That is modern monetary policy at work. And that means that you can end up with what is not just a boom in equities, but a bubble, and it's been created by the increase of money supply and the increase and manipulation of liquidity. That makes sense.
The U.S. dollar has long been the cornerstone of the global financial system, but cracks in its foundation are starting to show, and those cracks could open the floodgates for a surge in silver prices. The dollar's dominance is being challenged on multiple fronts, from shifting geopolitical alliances to reckless fiscal policies, and the implications for precious metals are monumental. Let's start with the big picture. The U.S. dollar's role as the world's reserve currency hinges on trust. For decades, countries relied on it for international trade and as a store of value. But in recent years, that trust has been eroding. Why? Because the Federal Reserve's relentless money printing and rising U.S. debt levels have significantly devalued the dollar's purchasing power. In just the past 3 years, over 40% of all U.S. dollars in existence were created. A staggering statistic that highlights the fragility of the currency. Now, consider the geopolitical landscape. Nations like China and Russia, and even Saudi Arabia, are actively moving away from the dollar. China is pushing for the yuan to play a greater role in global trade, while Russia and Saudi Arabia have started conducting oil transactions in currencies other than the dollar. These moves are part of a broader de-dollarization trend, one that reduces the dollar's influence and amplifies the demand for tangible assets like silver. But what does this mean for everyday people? As the dollar weakens, it fuels inflation, reducing the purchasing power of your hard-earned money. Meanwhile, nations and institutions are turning to precious metals as a hedge. Silver, in particular, stands out as a dual-purpose asset. It's both an industrial metal crucial for the green energy revolution and a store of value that benefits from economic instability. The writing is on the wall. If the dollar continues its decline, it will spark a flight to safety, one that will likely send silver prices soaring. But here's the thing. By the time the broader market realizes what's happening, it could already be too late to secure silver at today's prices. So here's the critical question. How are you preparing for a world where the dollar is no longer king? The signs are clear. Central banks are stockpiling gold and silver. Nations are diversifying away from the dollar, and inflation is eating away at wealth. For those paying attention, this isn't just a warning, it's a call to action.
The thing that people need to try to grasp is that money is media. It's media. It's a piece of paper with a picture on it. Okay? So run this thought experiment. There's this bank, and in the basement, they've got $1 billion in dollar bills. Okay? It's all in a nice, neat stack. Unfortunately, there's a spark from a piece of equipment, and it goes onto the dollar bills. Poof, they all burn. Now, the bank rings up the Fed and says, "Oh no, all our cash, it got burned. Oh, we've got to go bust now. Oh." Well, their money's burned. It's gone, right? So they're going to go bust now. But the Fed says, no, don't you worry. Just sweep up all the ashes, bring it to us. We'll weigh them, and we'll calculate how many dollars that was, and we'll print you some new ones, charge you for the paper. The bank goes, "Oh, we're not bust anymore. Oh, that's great. Life goes on." So what is reality and what is fantasy? When they had it there, was that $1 billion? Or was that a fantasy? Was it burnt? Was it gone? Or was it really still there? Or was it a fantasy? The point is, if you're a bank with a load of toxic money, but bonds, that money's gone. It got burnt. Someone else burnt it, or whatever, threw a party down the road, built a building. Yeah? But if the central banks step in and said, "Give us that, we'll QE that, give it to us, here's some treasury bonds, thank you very much." What happened? What's that going to do to the world? Nothing. What's not going to happen is the banks aren't going to go bust and take your money with them and crush all those companies that rely on them to process their payroll, et cetera, et cetera, et cetera, to collapse a load of companies that otherwise would have stayed in business making things and boosting the economy. So it's about the management of the system itself. Now, in the old days, if the system malfunctioned, it would set off a chain reaction that would create, systemic destruction. And people perfectly good, running perfectly good businesses, somebody running a cafe down the road, somebody running a bar, they'd go bust because their bank would go bust and all the money would be gone. They'd be ruined. Yeah. In the modern era, the central banker comes in and just says, "Don't worry about that so much. Oh dear. Okay, we're going to do this and we're going to do that." And the person that sat there going, "Oh, these banks always bail out all these corporations," doesn't realize that he just got bailed out. He just didn't lose all his customers. He didn't just have to say, "Where's all the people that used to come to my bar and buy drinks? Where are they all gone?" Well, they were in that bank that went bust, and now you're going bust. So when money is media, it's not a piece of metal that had to be dug out of a mountainside. And it's all about managing that as a machine. Well, it's a different game altogether. And they've got quite good at it. But what happens when there's a new systems are built, there's what I call a hidden variable. Many hidden variables which don't count in the old system because they are.
Predicting a breakout in silver prices isn't guesswork. It's about recognizing the key signals that precede explosive growth. History has shown that silver's biggest price surges don't happen randomly. They're triggered by clear patterns and conditions. So what are the critical indicators you should be watching right now? First, keep an eye on central bank actions. As mentioned earlier, their aggressive accumulation of precious metals is a flashing red light that they're preparing for something significant. Central banks rarely act impulsively. They plan for long-term stability. When these institutions start hoarding assets like silver, it signals a shift in their confidence in fiat currencies. The more they stockpile, the tighter the supply becomes, leaving less for individual investors. Next, monitor the gold-to-silver ratio. Historically, this ratio has been a reliable indicator of silver's undervaluation or overvaluation. For example, when the ratio is high, meaning gold is significantly more expensive relative to silver, it often signals that silver is due for a catch-up rally. Right now, the ratio is hovering around levels that suggest silver is significantly undervalued compared to gold, creating a primed setup for a breakout. Industrial demand is another critical factor. With silver being a cornerstone of green technologies like solar panels, EVs, and hydrogen fuel cells, any spike in demand from these industries could trigger a supply crunch. For instance, watch for announcements of new government policies or investments in renewable energy. These often precede significant surges in industrial demand for silver. Geopolitical events also play a pivotal role. Historically, periods of war, inflation, or major economic instability have driven investors to precious metals as safe havens. Given today's landscape of escalating global tensions and economic uncertainty, we're seeing the perfect conditions for silver's shine as both a store of value and a hedge against chaos. Finally, look at retail investor behavior. Retail demand tends to lag behind institutional moves, but when the public catches wind of silver's potential, it often results in a frenzied buying spree. This surge in retail demand can amplify price increases, especially in an already constrained market. The takeaway is simple. Silver's breakout isn't a question of if but when. By keeping an eye on these indicators, central bank activity, the gold to silver ratio, industrial demand, geopolitical events, and retail trends, you could position yourself ahead of the curve. The key is to act before these signals reach critical mass. So here's the challenge. Are you prepared to recognize these signals and move decisively? Or will you wait until silver prices are making headlines, missing out on the gains that come with being an early mover?
R plus zero squared, like a black Scholes, but those hidden variables don't count. But the new system pumps all the risk into those hidden variables. And they're invisible and they're invisible and they grow and they grow and they grow and they grow. Oh, now you've got a CDO. Now you've got a derivative. Now you've got your Lehman Brothers going bust. When these new systems come around, they mutate until they cause a new problem. So if you look at all the crises in history, financial crises, it's normally linked to a new financial instrument. And that financial instrument will be what causes that problem. Right now, in my opinion, the way that liquidity is being generated without a doubt, is driven this boom in the market in America. But the hidden variable is that certain stocks are getting so highly certain stocks are getting so highly valued that they risk becoming a systemic problem for everybody. So, if you go back to Japan, when they had their property boom, the value of the property of the emperor's palace was more than all the property in California. And then obviously it blew up. But the system of being able to borrow money for property was such that people could lever themselves up and lever themselves up and lever themselves up and buy more property to drive the price up, to borrow more money, to buy more property, to push the price up, to borrow more money, to buy more property, to push it. That is what they call a virtuous circle if you're long property. But it's actually a vicious circle because the system itself creates that never-ending spiral. And the only way, it can't keep going forever. It does have to blow up. And it blew up in the Japanese property situation. And markets blow up, whether it be tulip bulbs or be it the property system in the 2008 with all the derivatives. So they came up with all these property derivatives that drove the ability to finance property, to create property, to then market it from wholesale into retail. Because you've got the banks, they're basically wholesalers of mortgage debt and distributors of mortgage debt. And then you had people who were the retailers of mortgage debt and all these devices to take those borrowings and liquidate them back into cash, to lend it out again, to have more paper, to turn it back into cash, to lend it out again. Yeah. And so that was a virtuous circle that turned into a vicious circle. And they basically ran out of people to buy property. So that's why all these, zero money down, liar loan stuff came along, because that machine needed people to buy at retail, to buy those mortgages, to buy those houses that have been built off the borrowed money in that cycle. But of course, you run out of customers in the end. So you have to invent customers. And then the merry-go-round goes round and round and round until suddenly it breaks because it becomes a house of cards. And all financial systems go that way, particularly when you invent new instruments that give...
The stakes for individual investors in today's silver market have never been higher. While central banks and institutions quietly position themselves for a shift in the financial landscape, the average investor risks being left behind. The question is, will you seize this rare opportunity, or will you wait until silver is out of reach? Let's consider what's happening on the ground. Central banks are aggressively accumulating precious metals. Industrial demand for silver is surging, and geopolitical instability is driving a flight to tangible assets. Yet many retail investors remain focused on speculative markets like cryptocurrencies and tech stocks, oblivious to the seismic changes happening in the real economy. But here's the critical issue. Time is not on your side. The supply of physical silver is finite, and once the market fully awakens to its importance, prices could spiral upward rapidly. This is already happening in the wholesale market, where premiums for physical silver are rising due to limited availability. If history is any guide, retail investors often realize the importance of precious metals only after prices have already soared. By then, it's too late to secure meaningful gains. The industrial demand for silver only compounds this urgency, with solar panels, EVs, and hydrogen fuel cells driving unprecedented consumption. The pressure on silver supplies is growing daily. Meanwhile, miners are struggling to ramp up production fast enough to meet both industrial and investment demand. This creates a perfect storm: rising demand, constrained supply, and a window of opportunity that's narrowing by the day. And let's not forget about inflation. As the purchasing power of fiat currencies erodes, silver offers a hedge, a tangible store of value that has outlasted every fiat currency in history. For individual investors, holding silver isn't just about potential gains. It's about safeguarding wealth in a world of uncertainty. But here's the harsh truth. The longer you wait, the harder it will be to take action. As demand outpaces supply, premiums for physical silver will rise, making it increasingly expensive to get in. And when the mainstream finally catches on, the silver market will be a frenzy, leaving those who hesitated scrambling to catch up. So ask yourself, are you willing to take the steps now to secure your financial future? Or will you join the ranks of investors who realized too late that silver was the opportunity of a lifetime? The stakes are clear, the signals are undeniable, and the decision is yours. What will you do?
New powers and leverage to people in the finance industry. So go back to the crash of 29. That was leverage. That was being able to have margin. Margin calls that, because everybody go, oh, I can 10% down, I can buy a share, it goes up 10%, I double my money. I take my profit, I buy twice as many, I double my money. Yeah, that's going to work until suddenly it doesn't, and it blows you up. And back in the tulip bulb days of the Dutch, it was options. They'd invented options. Here's an option on a tulip bulb, and that generated it. Initially, it was because the princes in the Ottoman Empire, back in the day, when the Sultan died, they'd line up the princes, and the oldest one would get to be Sultan, and they killed the other ones. That was kind of a pretty brutal thing to do, but that's what they did. And then they thought, this is a bit brutal, even for us. What we're going to do, we're going to lock them up in prisons. And they locked them up in prisons, and they all took up gardening. And they loved tulip bulbs, so the princes of the Ottoman Empire would send off to find tulip bulbs from all around the world, and they paid top dollar for that. And because there was these princes buying very rare, very expensive tulip bulbs, it generated a virtuous circle in tulip bulb prices. And then people started writing options on them. And that option market drove the tulip bulb prices nuts. And that's what caused that crash. And then they invented paper money. And then you got I can't remember which one was it. The South Sea bubble was paper money. John Law. And they invented paper money. And certain dukes went, I've got all this paper money. I'm going to run down the bank and take my gold. This is never going to work. And that cash flow, South Sea bubble was actually shares. The original equities caused the South Sea bubble. So all these new inventions of new financial instruments caused all these boom bubble bust cycles. And, they've invented a new way of managing liquidity and money these days. Because the old method was, we're in a recession, hand out money to poor people. And they rush down to shops and buy things, and the prices go through the roof, and you get inflation. The new method is, hand out money to rich people, and they'll put it into property and stocks, and it won't cause inflation, because it won't go straight down the supermarket for lettuce and stuff like that. So during COVID, when they handed out money to everybody, guess what you got? You got inflation, because you handed it out to people that needed to spend it. Before, they were handing out to people that didn't need to spend it, and it trickled down. And now they're back to that model again. And the thing is, I think it will probably, in the next year or 2 or 3, drive that final part of the boom bubble bust cycle. And you'll see it in the NASDAQ. And then you can play that bubble, but make sure you're near the exit when the alarm goes off.
The evidence is overwhelming. Silver is on the brink of a historic surge. We've examined the growing geopolitical tensions, the strategic moves by central banks, the booming industrial demand, and the looming dollar decline. All these forces are converging to create the perfect storm, and when it hits, silver could skyrocket to levels most investors never imagined possible. Let's connect the dots. Central banks are abandoning fiat currencies in favor of precious metals, using them as a shield against global instability. At the same time, industrial demand for silver is climbing rapidly, fueled by the clean energy revolution and its role in solar panels, EVs, and hydrogen fuel cells. This isn't just a trend. It's a fundamental transformation of the global economy, and silver is at the heart of it. Meanwhile, the U.S. dollar, the world's reserve currency, is losing its grip. Decades of money printing, rising debt, and geopolitical shifts have eroded trust in the dollar. Nations like China and Russia are leading the charge toward de-dollarization, stockpiling tangible assets like silver and gold as a hedge against economic turmoil. As the dollar weakens, the demand for silver as both a store of value and a critical industrial metal will only intensify. The result? A supply-demand imbalance of unprecedented proportions. With mining struggling to keep up and central banks and industries absorbing every available ounce, the silver market is poised for an explosive breakout. And when retail investors finally recognize what's happening, the frenzy will push prices even higher. But here's the bottom line. The time to act is now. Waiting for silver to hit the headlines means waiting until the opportunity is gone. As history has shown, the biggest gains go to those who position themselves early, before the market fully realizes what's unfolding. So what will you do? Will you take action today to secure your piece of the silver story? Or will you watch from the sidelines as the price soars out of reach? The choice is yours. But remember, opportunities like this don't come around often. And when they do, they don't wait for anyone. If you found this insight valuable, don't forget to subscribe for more content like this. As always, this isn't financial advice. Do your research, weigh your options, and make the decision that's right for you. The silver surge is coming. Will you be ready?